Hello and welcome to our class number 6, where we're talking about different types of financial institutions. Last week, in our 5th class, we started talking about mutual funds. We talked about what they are and what are the benefits of mutual funds for individual investors particularly. And we also mentioned that mutual funds are very, very popular as an investment among individuals. In this short class, we are going to briefly talk about types of investments that mutual funds make themselves. So the funds that mutual funds collect from a number of small individuals or other investors are actually invested into other financial assets. So in this way, mutual funds actually also act as a financial intermediary. Again, in this lecture, we're going to talk about different types of mutual funds based on their investment objectives. So based on what the mutual funds invest their money into. And basically, there are 4 main big types of mutual funds. These are stock funds, another name for those would be equity funds, bond funds, hybrid funds, and money market mutual funds. So talking about each of them, equity funds or mutual funds are of course mutual funds that invest their money into different kinds of stocks. Bond funds are the funds that invest their money into different types of bonds. Hybrid mutual funds are the funds that invest their assets into both different kinds of stocks as well as different kinds of bonds. And money market mutual funds are the mutual funds that invest their assets into money market instruments. Money market is basically a market for extremely short-term borrowing, which is very, very liquid. Examples of money market instruments would be negotiable CDs, commercial paper, T-bills, basically extremely short-term borrowing. And as we see from this chart, by the way, all charts in this class are from the investment company fact book, that's 2018 edition. As we see from this chart, stock funds or equity funds are by far the most popular. They make up 55% of all mutual funds nowadays. Second most popular are bond funds with only 22%. After that, we see money market mutual funds, and hybrid mutual funds only make up around 8% of all the mutual funds in total. That's for US. This is not global data, that is the data for United States. Now, what we see from this chart is that actually households are the main investors in mutual funds. As I mentioned in the previous class, mutual funds mostly generate large, significant benefits for small investors, for individual investors who cannot easily diversify relatively limited amount of funds among many different kinds of financial assets. So since those benefits are mostly applicable to small individual investors, I guess it's only expected that those small individual investors make up the majority of investors into mutual funds. In US, as we see in 2018, households make up around 90% of total investors into mutual funds, and only the remaining 10% are the institutional investors. And among the households, most of the money, as we see, goes into longer-term mutual funds, including equity, hybrid, and bond funds, and a small percentage goes into money market mutual funds. Whereas for institutional investors, it's just the other way around. Most of the money from institutional investors goes into money market mutual funds, and a smaller percentage goes into longer-term other types of mutual funds. And the last thing I want to mention for today is this very interesting type of mutual funds, which are index funds. Basically, these are mutual funds that invest into all of the stocks contained within some stock index. For example, S&P 500 includes 500 of the largest companies in US, and mutual funds that kind of track this S&P 500 or mimic the performance of this S&P 500 would basically invest their funds into all of the stocks contained within this index. In that case, of course, whenever the index is going up, then mutual fund performance will also go up, and vice versa. Whenever S&P 500 is not doing well, the performance of that specific mutual fund would also be hurt. But the benefit of this type of mutual fund, by the way, this is within the stock funds, within the equity funds. The benefit of this type of mutual fund is generally lower management fees. So for that reason, this type of mutual funds have been becoming more and more popular over the last decade. And they've actually doubled in their popularity in percentage terms. So more than a quarter of all mutual funds nowadays are actually index funds. I think it's quite interesting. What do you guys think? Do you prefer to invest into stocks that you choose personally, or do you have some investments in mutual funds? That is all for now. Have a nice day.